Hello and welcome. Franklin Templeton, a leading mutual fund in India, closed down 6 of its schemes today. The schemes were what they call yield-oriented debt funds. So essentially, this is different from equity, and these are invested in different kinds of instruments. And the total assets under management in these six schemes adds up to about 26,000 crores. Now, this amount, we are told by the Association of Mutual Funds of India, is less than 1.4% of the entire assets under management by the Indian mutual fund industry. Now, however, coming at a time like this obviously sets off warning bells. It causes concern amongst investors, and we all want to know what's going to happen, particularly if debt funds, which are traditionally and supposed to invest in safe harbor assets, are also either closing down or holding off their redemptions. Redemptions is when you and I ask for our money back and we don't and we get it. In this case, we're not getting it because the fund has said that it will pay it out in a staggered manner. So let's try and understand why this has happened and what it means for people who are invested in the mutual fund industry in a very simple explainer format. To do that, I'm joined by two experts in personal finance and investing, Vishal Thakkar of ConTeTra Universal, and I'm also joined by Neville Poncha of IntelX Money. Thank you both for joining me. So, Neville, let me start with you. Franklin is a big name. There's no doubt about that. But this also is not all of Franklin. Only one part of Franklin's assets, which is these 6 funds, have shut down. So how are you reading it?
What has definitely happened is that it has affected the investors. We've got a flurry of calls in the morning asking us about how our money is safe. The funds which have been affected are funds which invest in, say, slightly riskier paper. This is not the AAA paper which people normally think of when they're investing in debt papers. There are also some papers which will be of slightly longer maturity, 3 years, 4 years maturity. What we have seen in the last couple of months is that there's been a flight to quality and there's been a bit of a liquidity issue. A few weeks ago, we even had liquid funds, which are even safer than this, giving negative returns because many of the investors just move their money out of the market. So I think this is more a liquidity issue. And then when Amphi says it's a small portion, it is a small portion of the total mutual fund AUM. And hopefully, in a staggered manner, we should get payouts.
Right. Okay. Vishal, how are you seeing this? And I'm sure you're also getting calls. And I know you also advise a lot of people on the fundamentals of investing. So what are the fundamentals looking like here?
Okay. So if we look at these are unprecedented times, it has definitely shaken the confidence of investors because, when we see that our money is not going to come back or it may come back in a staggered manner and there are no assured timelines given. So there are concerns that are there, but there is no reason to panic because Franklin Templeton has just closed down 6 schemes. However, at the same time, it is definitely a red flag, but one need to understand slightly in detail that when we say that traditionally debt funds are considered safer, we have to look at risk adjusted returns for these funds. If you look at last about 1 year, there is hardly any debt oriented fund which on a risk adjusted basis would have given anything more than a bank deposit. In fact, the concerns were so high that SEBI had come up with the mandates and notifications where they have put checks and balances on what a fund manager can do and cannot do so far as the debt oriented mutual funds are concerned. There are sectoral caps. Unlike good old days, a fund manager can just not strike a sweet deal with a large corporate house and pick up a large chunk of his paper. And in terms of the risk, some of the schemes are actually way more riskier than what they are perceived by the market, especially if they are credit linked or as my fellow colleague rightly said, is not AAA rated. So definitely there is a cause of concern for the investors, and that's the reason why we have seen a chunk of withdrawals in the recent times as well.
Right. Now, to most lay investors, people particularly who invest through systematic investment plans or SIPs would not really know. I mean, I was just looking at the names. Franklin India Low Duration Fund, Dynamic Accrual Fund, Credit Risk, Short Term Income, Ultra Short Bond, income opportunities. I mean, these names don't tell you anything. I mean, if anything, and if someone says it's a debt fund and these are the 6 different kinds of debt funds, obviously a normal person is not going to know, or will they? Vishal?
So, see, for a normal person, an advisor would tell him that as a part of balancing your portfolio, a good percentage of your money should be going in debt fund, because historically equities are perceived to be risky. But when it comes to this is at the asset allocation level. But when it comes to scheme allocation level, I don't think in our country we have a very healthy practice of disclosing by the advisors as to which particular schemes are being chosen, or if at all the material is circulated, I don't think our retail investors would have time, interest or bandwidth to go into so much of details. The fact that they already have appointed an advisor and they would expect the advisor to act in a fiduciary capacity. So having said that, I mean, for a retail investor, these nomenclature would hardly make any sense.
Right. So Neville, how does I mean, I know that as we go forward, clearly the one lesson is that you need to now start, even for debt funds, reading the fine print more carefully. So what is that fine print that people missed or should have read in this case?
So I think in this case, there have been a couple of warning signs and flags raised earlier also. A couple of their earlier investments did run into problems. They were segregated earlier also. So I think that should have been a bit of a wake-up call for investors. But you're right, an investor will not really figure out the difference between one AA company and another AA company. The simple metric which we use when we are talking to our clients is we show them the portfolio and we ask them, how many of these names can you identify yourself? You know, if you can't really figure out what this company does, or you've never really heard of this company, don't invest in a fund where you don't know where your money is going. A lot of people then say, my advisor will handle this and my fund manager will take care of all this. But in the end, if something does go wrong, because the fund manager is going as per the mandate, in a credit risk fund, he has to take credit risk. He can't put triple papers. So I think very easy. It is easy for the investor to choose the fund correctly. There's a semi-categorization, which actually now helps. So you don't have to go by the name of the fund, but look at the category of the fund. And that's what the investor should do going forward.
Right. So Neville, the other point and important point is that a lot of these investments that are being pulled out from all these funds are being pulled out by companies, not necessarily individuals, because they themselves are facing liquidity challenges, because their income streams might have slowed down. They still are paying salaries. They're managing their enterprises. So we are in an unusual situation in a much broader sense. So therefore, what does this mean? From if we are trying to assess the environment as a whole, rather than, let's say, the specific symptom that we've got here?
Given that the environment is challenging, we've seen investors, be they company investors, HNIs, or even small retail investors, looking to move to more liquid categories. Many investors have done it. We've seen categories like overnight funds, which were very small a year ago, but are quite large now. So some investors have understood the risks of liquidity. Some have not understood the risk of liquidity, but there's not much you can do if tomorrow a large corporate or a bunch of corporates at one time move out. As I said, we saw it last month where, people moved out of liquid funds and we got negative returns. And honestly, there's nothing you can do as an investor to take care of those risks.
Okay, Vishal?
Okay, so I look at it slightly differently. See, let's evaluate the need for liquidity. So I would broadly put them into two buckets. One is the corporates or companies which would park their excess money in liquid funds or these debt-oriented mutual funds, because they would be slightly better off than bank deposits. Plus, they offer the much valuable liquidity which is required at such unprecedented times. So I would say that it is natural for a lot of companies to withdraw in chunk at this point in time, because as rightly said, they need money for expenses. On the other hand, what happens is that let's talk about individuals and HNIs who have parked their excess surplus mostly from a long-term perspective. So what is going to happen is that for them, the choice is between a bank deposit and a debt-oriented mutual fund. So the question really arises that for getting that 1 or 2 extra percentage, what is the kind of risk that they would like to take? And for them at this juncture, a closure, a unilateral closure of a scheme like this would definitely come as a shock. Because if Franklin Templeton would have given a proper schedule of repayment, or if it would have honored the maturities, then the story would have been completely different. That the corporates are withdrawing because they need liquidity right now, but the HNIs need not worry, your funds are safe, and over a longer period of time you will continue to get, let's say, less returns, but then you will not lose your principal at least. So I think
but the fund is also saying, I mean, Franklin Templeton is saying that your money is going to come to you, but obviously it will come at the pace that we will control now, as opposed to you submitting a redemption and then asking for the money tomorrow.
That is clearly credit risk that we are staring at, my friend. So while a fund manager may take a lower rated instrument and take a credit risk, but he can't do the same with unit holders. No, there is a difference between two stakeholders, my friend.
Okay, fair enough. So let's understand. I mean, in the context of the environment that we are in, how should investors be now looking at investments in general? And when I say investments, I mean we're talking about mutual funds today. And what are the three things they should be doing or not doing?
Okay, so let me quickly tell you, in such unprecedented times when we are not sure of the direction and the tenure of the pain, right now no action is the best action. Because if you try to look at something and it looks like opportunity and you try to grab it, it's like a falling axe. It might just cut your hand. Okay, if you have parked money for long term, you continue doing your long term investments. And if you are running short of liquidity, you can cut down on your SIPs a bit, because you will need money for expenses, at least in an absolute near term. So step one, do nothing unless you absolutely need liquidity. Step two, re-look at any of those risky assets which are now coming to light, considering the situations. Even in the debt funds, you may want to switch, either if you have a more risk appetite, to equities, or maybe go back to the bank deposits. And step three, buy at every dip in very, very little proportions. Don't bet the ranch. But if you are identifying some really good blue chip stocks, or you are staring at some mutual fund houses where the NAVs have really hit the bottom, then picking up a few units will not hurt you in the longer run. So according to me, these are the steps.
Okay, so you're saying that I mean, it's broadly safe, or it's not safe, but at least you're not writing off the entire sector as far as future investments go. Neville?
I think what investors should do is relook at their portfolios. Everybody is at home. It just takes you 15 minutes to go to the fact sheet of every portfolio. All the details are out there. Investors can easily choose funds which are AAA funds, or have, understand the category. The simplest category to invest in is, if you have a long-term horizon, is the corporate bond category. If you have a shorter-term horizon, it could be the money market category or the liquid fund category. These are invariably safer categories, more liquid categories. And if you want to be ultra safe, there are also some very good government funds which invest in government securities. So those are liquid at whatever maturity. The issue here is the question of liquidity. We also saw, just to take another example, a few days ago, we saw the oil price. That was really a question of liquidity. We've also seen in overseas markets, not affecting our investors, but some real estate funds which had daily entry and exit shutting down. So basically what the fund structure allows a person to get in and out at any time they want, but their assets are illiquid. And when these events occur, that causes the problem.
Right. So last question to you both, Neville. As we go forward, do you feel that this could escalate in some ways? And if so, what should one do or not do? And your outlook, at least as things stand today. Neville, you want to go first?
Yeah. So I hope this doesn't escalate. I don't think it does. I think the steps taken by Franklin Templeton are more to ensure that it's done in a more orderly fashion. That's one. I think investors will also now, learning from this, be slightly more cautious as to where they invest, speak to their relationship managers in banks or wealth managers and ask them a bit more about their investments. And I think people will be more conservative, and when they make their investment, maybe more knowledge, spend an extra 5 minutes asking the right questions. So I think it's actually, in the long run, a good thing which has happened.
Okay. Vishal? And I also want to add one more question, Vishal. I know both of you have said that as an investor, you should be looking at the composition of those funds that you will invest in. But what is AAA today may quickly turn to single A tomorrow, isn't it?
I was just going to come to that my view is slightly different. See, I mean, since the time the Janta curfew happened and we went into a lockdown, we have stepped into a new world altogether, and we are yet to understand the dynamics and the rules of how this new world is going to operate. Because most of the events that have happened since that day till today, as we speak, are unprecedented. There is no precedent. So I don't feel that this is a standalone event, and we may see more closures happening. We may see more pain in the market because liquidity is something which gets challenged first when we encounter such situations. So the pain is not yet over. The peak is not yet come. The curve is not yet flattened in either in the COVID sense or in the economic sense, and rather economically the pain is going to last much more longer before all of the sectors come back. And in last 20 days I have done several webinars where I would have addressed not less than 5,000 people, and all of these guys have had similar concerns. To all of them I have said, at this point you be cautious, hold on to your liquidity, because that is something which is going to save you, at least to keep your head above the water.
Okay.
Neville, do you want any last word on that? Do you want to respond?
My point is, do look at your portfolio, even portfolios which have debt, which could even be in your hybrid funds. Look at issues which could happen there. I don't think we should say that a couple of AAAs have gone bust, so therefore all AAAs are equivalent to all BBBs. In the end, look through your portfolio. There are categories which are only funds which only do banks, only do PSUs. So therefore, a cut above the rest. There are a lot of safe funds available today. Don't just be blinded by past track record and past returns. Look and see for the future, and there are good safe investments in the mutual fund space too.
Right, and read the fine print. Thank you very much both most important. Thank you very much, Vishal and Neville, for joining me. Hopefully, things will stabilize in the debt market, but then we've still got 10 days to go out of the lockdown if we do on the 3rd of May, and that's when there will be a new beginning, so to speak. Thanks so much for watching.